Hey, this is Jay Soloff from Investors Alley with the options trade of the week. So what we're looking at here again is Market Chameleon, and if we go to options, we're going to look at this time at unusual option volume. So this is a list of stocks that have options that have traded a lot more than their average volume for whatever day we're looking at. This one I'm looking at July 5th. So you can see a list of different stocks and how much it's traded and what it's traded relative. So relative is the daily volume divided by its average volume. So you can look at something like, this one's 53 times the normal volume. So if we look at that, that's actually the New York Times company. So New York Times, famous paper, doesn't generally trade a lot of options. So we can look, and there's only about 6,000 some contracts, but that's a lot more than it normally trades. And you can look again here. It's almost all in the calls, 99% calls, 1% put. So it looks like there's a big call trade. So what we can do is click on that and see, maybe we can see what's going on. So this brings us to the options chain, and we can look at, we don't necessarily know what month this big trade happened in, but that's why you go over here and you look and you can see there's all this volume. It looks like it's all in this August expiration. Maybe it is relating. You can see earnings are that. So earnings are actually at the end of July. So this was in fact an earnings trade, most likely betting on earnings. You could see it's all these 36 strike calls with the stock at 34.68. So now we can see if we can maybe find that trade more specifically. You can go to this trade list over here. A quick shortcut is you can go to this key trades, and this will usually pick out most of the big or interesting trades that happen. There was only that one, and sure enough, one trade happened at a block of 5,236 contracts. So that's a ton for something that doesn't trade all that much. Here's the graph of it. Basically, you can only lose what you paid for the call, and then unlimited gains once you hit the break-even point of 36.80. Here are the details. All right, the open interest was only 11 contracts, so this is a brand new opening trade. It's not a closing trade. They paid 80 cents, so they paid the ask price, so someone's certainly buying these options. This was done when the stock was at 34.27. It's already at 34.68, so it's already gone up probably because of this big options trade. So someone spent $418,000, almost $419,000 on these calls, but there's a chance to make basically that much, 500. So if you were to break this down into what you can make on it, you can lose that 419,000 if it goes here, anywhere down below here. You'll lose a little bit all the way to break even up here, 36.80. But this is basically every dollar you'll make about 500,000, or the person who made this trade will make about 500,000 for every dollar. So obviously they're counting on a bigger move up. They are not just, you don't just dump 419,000 into a stock that doesn't trade options that often, unless they really think something's coming up. Earnings come out before these trades, so before these trades expire. So this is almost certainly a bet on earnings. And looking at the chart quickly, we can look at what it's done over the last year. Let's see here. So you can see it's been pretty sideways. So this is expecting a breakout, at the next earnings period, and kind of right around the 50-day moving average, way above the 200-day moving average. So this is definitely, this is almost certainly, this doesn't look like a technical play. It doesn't look like this really looks like a play on earnings. So earnings are at the end of the month, and these options, so there are no options that expire that week. There's this doesn't trade that much, so there are only a couple periods that trade. So July 19th would expire before earnings. So the next closest thing they could trade is August. So that's why these were done a few weeks after earnings. But I would be willing to bet that this is a bullish play on earnings, and it's the sort of thing that you could do if you were interested in doing something similar is buy these 36 calls. They don't cost a whole lot. Let's see, the buyer paid $0.80. So you'd have to pay a little bit more than that. You'd have to pay 95 cents, but so $95 per contract. Not a lot if you wanted to take a bet on New York Times going up. Certainly someone thinks it's going to go up and spend a lot of money betting on that to happen. So if you want to learn more about this sort of thing, buying calls, buying puts, doing different option strategies based on expectations of the stock, you can look at my Options Trading Mastery courses and just click the link nearby, and it'll take you to a page where you could learn more about that product and how to learn how to trade options more effectively.